To achieve the extraordinary, you need partners. People who will match your ambition. Backing you to find a way. Because they see in you what you see in yourself. Someone who will never settle for ordinary.
Good evening, everybody. As you can see on the screen, my name is Scott Stanton. I'm the head of banking for Investec Private Bank, and it truly is my privilege and pleasure to welcome you all here this evening. So thank you for everybody that's here in person. Thank you for all of those that are attending online. I think we've got just under 500 people here in the room. We've got over 100 people online, and it really is a fantastic turnout. So thank you very much. It's also amazing to see such a diverse audience. And that comes in many shapes and forms. And from an age demographic, we've seen some young professionals, some middle-aged people, and then some grey-haired people like myself, which really does talk to the need for sound investment advice and planning from an early age all the way through into your retirement years. So thank you all for coming. It's great for you to be here. I was going to start off by saying we're in very uncertain times, but it does feel like we've been saying that for quite a few years, and we definitely used it too much in the 2021, 2022 years during COVID. But we certainly are faced with a lot of market uncertainty, geopolitical tensions, and it can feel daunting. So what we would like to do tonight is to engage in a conversation to see how we navigate through these times and how we look into some of the challenges and try and find opportunities for you. The one thing, though, notwithstanding all the challenges, is that we remain steadfast in is our commitment to you, our clients. At the core of everything we do is our clients at the center. So with clients that are content and happy, we know then that we are doing our job. We do like to see ourselves as a trusted partner in your wealth creation journey. And what we aim to be is a leading international private bank, wealth manager, and legacy partner that puts you, your family, and your businesses at the center of an integrated ecosystem that is deeply personalized for you. And what that means is for all of our clients, our newly qualified graduates, our young professionals, all the way through to our high net worth clients, we have an offering that is tailor-made for you to meet your banking, insurance, investing, and wealth management needs as you grow through your life. We don't look for a one solution that fits all. We do pride ourselves in creating tailor-made solutions. We do have over 20 years of experience in the investment realm. We've developed a strong foundation in asset allocation and risk management, and our global reach, which is really important and I guess will be spoken about tonight, gives you access to leading international fund managers and diverse markets. This empowers you to make informed decisions that stand the test of time, and what we will do is work very hard to make sure we can focus on what truly matters to you. So tonight we're going to explore our investment philosophy. We'll discuss how approaching investing with an eye towards balancing financial returns with sustained long-term growth. We're also going to address some of your concerns about investing today. Your insights and your concerns are really important to us, and we hope to provide the clarity to you as to how we can better serve you moving forward. So we look forward to embarking on a journey with you, and let's focus on turning uncertainty into opportunity and strengthening our partnerships for the future. I'm also pleased to introduce Ferial Haffajee, who is the Associate Editor of Daily Maverick. I did say to Ferial that I don't need to introduce her because I actually think everybody knows who you are. But thank you very much for being with us today. As we know, Ferial, you're a seasoned investigative journalist with a wealth of experience in your field. and we're really looking forward to the insights that you can have. So thank you for joining us. I'll call you up in a second. And then also following on from Ferriel, we're going to hear from Chris Holdsworth. He's our Investec Chief Investment Strategist, very well known for his market roundups every Monday morning called Macro Mondays. And Chris is going to share his perspective on where opportunities lie for South Africans in the near future. And following that, we're going to have a panel that will share some more about our processes and our philosophy in investing. So thank you again for being here tonight. We're really looking forward to an engaging evening, and we appreciate your time. So please join me in welcoming Ferriel to the stage. Thank you, Ferriel.
Very much, Scott. It's really lovely to be here with all of you. And I am super excited that there are so many people like you who haven't semigrated and who still call Joburg home. We have work to do here, people, and we do it with people like you. So I find myself to be I try and see the world through optimistic lenses. And at the weekend, some of you may have attended the beautiful Latitudes Art Fair. And at it, I saw that William Kentridge, one of the signature pieces of work, was by a print by William Kentridge, and it was called #In Defense of Optimism. So that's the theme of my talk this evening, as I whip you through some of what I think is happening in our political landscape. So these were the words that come up quite regularly. We've made a word cloud of some of the emotions that you told us you were feeling. So uncertain, volatile, anxious, concerned. Last year before the elections, when we did a similar, we looked at the Ndlula Miti scenarios, we found that the word that described South Africans most was disappointed. It was quite a sad word, and people were disappointed because largely of load shedding. Load shedding, I would argue, is mostly behind us, I pray, but still, this is the word. These are the words of how we described ourselves. This is another word cloud that we drew up, and this is something I took from the leading global headlines after the Oval Office meeting. And what is interesting for me is even though immediately I thought things had really, really gone terribly, in fact, that Oval Office meeting may turn out quite well for our country, and I'll go into that a little bit more. You can see, and this is from New York Times, Bloomberg, etc. Most of them were debunking many of the myths that came up in the mini-doc which was played that evening. So who I'd want to speak about tonight is that 10 years ago in 2015, our country was in the thrall or in the hands of a group of people at the heart of the state capture project. I'd like it to take you through some institutions to show you that now I believe all those institutions are in the hands of people who I call the fixers. Whether they're doing a good job or not is something we can chat about in a little while. And what do you think of my first fixer? I'm guessing most people are going to say, no, she's not doing a great job. Shamila Batoy inherited a captured National Prosecuting Authority. I think that by the time she leaves office next year, she'll go down as one of those leaders who fixed up ahead of somebody else coming in and doing the big prosecutions, which will result in the orange overalls that many, many South Africans want to see. But just a few data points there. Many investigations have been authorized by Andrea Johnson, who I'll get to in a moment. 37 enrolled cases. Because of the rapid speed of our news agenda, we haven't noticed that one of the kingpins of state capture, Mr. Ace Magashule, has been on trial in the Free State in the roofing, the asbestos roofing project in the Free State. There have been summons issued against 78 entities. 3 women here Omar Rasitaba there in the red T-shirt, Shamila next to her, Andrea Johnson behind her, Anton Duplessis next to them. People who I think are putting in 20-hour days and really beginning to turn around this institution. Oma over there, sadly, she leaves quite soon. She's responsible for about 8 billion rand in corrupted assets being frozen until prosecution, or well, investigations and prosecutions happen. She's quite a dynamic woman, and I hope she stays for a little bit longer. So this is what Zapiro makes of my first fixer. He doesn't quite buy my story, and just there you can see all the headaches that Shamila might face. This is another person who I put up there, Michelle Phillips, the group CEO of Transnet, just beginning to turn around the institution that really is at the heart of our story if we are to begin to see growth in our country. Important work being done, private sector being introduced into many key parts of Transnet. It moves very slowly, as does Shamila's work. So this is a guy you may think, Ed Kieswetter, the head of SARS. You may think, why on earth? He is hurting our pockets. He has really upped collection rates, not sufficiently high, but he's got an extra, I think, 7.5 billion rand in budget 3.0. He's the only one who kept his line items along with a few others. So why I put Ed Kieswetter in here is that he's become quite a weapon against state capture. He's adopting the Al Capone model, where you get the mafia on tax cases, even though the NPA is taking so long. I saw in a recent annual report of his that he's got 33 state capture accused under the whip, frozen assets, investigations, etc. And that, I think, is a good story. And then here is my favorite fixer, who sat here on the stage with us a couple of years ago, maybe even last year, Mteto Nyati, the Eskom chairperson. I think this is the guy, along with a few other people, who've seen that we end the era of load shedding. I think we may still see a few bouts if winter gets any worse, but on the whole, the reform of Eskom and of our energy market is underway. And we should have known this because he wrote a best-selling book called Betting on a Darkie. Everybody read it, I hope. It's in its 8th imprint or something, of how he changed various workplaces, now runs his own investment holding company while being the Eskom chairperson. Here's my other favorite, Andy Motibe at the SIU. This is a dynamic, quiet advocate who really who's really our biggest weapon against corruption in our country. A couple of the investigations he instituted at important institutions you see there. And then today, this slide wasn't going to work unless he didn't drop those interest rates today. Our conservative governor, but really a very steady hand at the tiller, oversees a very vital institution, and boy, did he stand up to bullying. It's not well known, but many of the key actions against state capture were taken by the Reserve Bank, so someone who really is right up there. We're in the middle of an infrastructure bonanza. The property companies may not believe it. There's 1 trillion rand earmarked over 3 years with private-public partnerships. So it's not all going to come from the state, but you're beginning to see what this could look like over 5 to 10 years. The Mtento Bridge under construction, the Polihadi Dam with its twin, the second part of the Lesotho Highlands water project. Anybody in Joburg had water problems? Or we all put in JoJo tanks already? This is the thing that could begin to sort out our problems. Also, if we change the boards and the executive of Johannesburg Water, but we'll get to that. Digital public infrastructure. This is a guy I met in Cape Town, Tariq Brown. He owns something called Too Much Wi-Fi. It's a social impact enterprise. He came back from Canada. You regularly meet people like these who come back because they want to do things impactful, big for their country, putting in really cheap Wi-Fi, mostly in the Western Cape, but should get here quite soon. So let's talk about our GNU. Last year when the GNU was formed, can you believe that today, I think, was a year since the election? And things are so busy, we in the media didn't even sit back to say what's happened over a year. So it takes us 12 to 13 days to form a government of national unity. Even The Economist says that's a really cool thing you've done there, because it takes other countries maybe months to negotiate coalition governments. People first love this GNU. The most popular person, can you believe it, amongst Daily Maverick readers is Gayton Mackenzie. Do you get that? I see some Gayton fans here. But what happens in this government of national unity of ours is very importantly, for the first time in 30 years, we see internal competition. Hosienso Ramahopa, the electricity minister, wants to be better than Dean McPherson, the public works minister. And so things begin to roll. Not at a pace we need, but they're competing with each other, and it's a good thing. They also fight a lot, and I'll get to that. The price we pay, though, is very, very expensive. Look at all those deputy ministers. I'm sure, like me, you can't name anyone except maybe David Masondo and Ashur Sarupin, who are the two deputy finance ministers. For the rest, this is the cost of a 10-party GNU. And this is the way our politics looks for the next 10 to 20 years. Today, a reader of the DM asked me, can't we get some help to bring down the size of this cabinet? No, we can't. I think this is the size cabinet we sit with. And it's huge. It's bigger than America's. It's bigger than most BRICS countries. It's the price of patronage and of power sharing. So this was the outcome of the election a year ago. And I think this is how our elections look from now on. Most people, and I'll show you some polls to show it, I don't think we'll ever have a majority party again. I don't think the DA is going to win again. And this era of power sharing, of coalitions, that is our political landscape. And for all of you, many of you run businesses, wherever we sit, we've got to find our way in this time of power sharing. This one, for me, I think I may have shown it to you before, but this is the one that should worry us. Because what it tells us, if you start at the bottom, 94, 99, we are very keen voters. We're in the system. We're very keen to make our voices heard using an X. By the time we get to 2024, lots of us don't go and vote. And young people mostly don't go and vote. So unless we don't get our young people into work and invested in the system, then I think things get a little bit shaky. These were just quick 9 fault lines that has faced the GNU in its first year. Add 2 to that, international relations and Starlink. Should we give Starlink a special deal or not? That was in Parliament yesterday. Also, Elon Musk got fired today, have you know? Or he left, or whatever. And this was a State of the Nation report card. As you can see, it's not great, but it's not as bad as the popular narrative would suggest. There's important areas. Obviously, the most important one, inclusive growth, and we are not getting there fast enough. In fact, today, lots of our growth forecasts have been lowered after Budget 3.0. That's the one we've got to work on. So for me, the scenario for the GNU going forward, I think the status quo has succeeded. It will last. After the turmoil of our 3 budgets, in fact, they've decided to stay together. This is still an option. This is just where Action SA of Herman Mashaba and Musi Maimani's Build One South Africa goes into the GNU, makes it 12 parties. This is unlikely where the EFF enters the GNU. The EFF is, in fact, becoming the official opposition as MK just kind of withers. And this was the one that I thought might happen. This is where the DA leaves, and there are many people in the DA who do want to quit, but not the ministers, because they're enjoying the competition. So the ANC then, with 9 other smaller parties, has a majority of 52%. Not great for stability. This is just something I've tracked since December. and it became our story in the past 2 weeks. On 15 different occasions, we came into the crosshairs either of congressmen, and there were men in the US, social media posts either by the Secretary of State or by the US President Donald Trump himself. For many reasons, and we don't have time to go through it here, our country really was the center, along with others, of US attention. Many reasons for that, but there was a history to that to what happened in the Oval Office. This is important, yes, because we export things to the US and for AGOA, but more importantly, over 600 companies here are American satellites of big US companies. Quite a few of them are really big ones. You can see from that. Here, they invest quite significantly in very many hard things, FDI, but also soft things, massive investors in skills, in DEI, even diversity, equity, and inclusion. Even though America is cutting down on this, these companies are leaders from the days of the Sullivan Code. They're not so happy here, so it wouldn't take a whole lot for them to disinvest, and that's something we should pay. And here's why the September AGOA meeting and the November big review of the AGOA, that's the African Growth and Opportunities Act, is so important. We sell a lot of cars and a hell of a lot of nachos to the US. Many, many jobs at stake, especially in the Eastern Cape, very poor region of our country. The reason John Steenhuisen was an effective part of the delegation is because so many jobs in the Western Cape depend on these exports to AGOA. I think it's been saved, but those dates in September in the DRC, in November in Washington, very important. This is what the offer we put in the table after the meeting, after the Oval Office part of the meeting happened. They went behind closed doors and they actually started talking nicely and sensibly to each other. Critical minerals. We're big exporters to the US, and this, I think, is going to be the cornerstone of whatever trade deal is struck, and there will be a trade deal struck. Quickly, people they started out loving the GNU, and when Ipsos measured sentiment, you can see that we're getting a little bit tired of all the drama and the fighting. Interesting for me is people think it'll fall apart. Quite a number think it'll fall apart because the parties differ so much, so they should tone down on those big fights. But the positive perceptions, look what's happening. Because you don't palpably feel it in service delivery standards, growth, and jobs, we're getting very tired of it. And this is an important factor of where our politics goes to in the next few elections. Everybody's asking me, will Paul Mashatile be the next president of the ANC? I think he will. I don't think it's correct that Patrice Motsepe is running. I do think Fikile Mbalula is going to try and run against him. But yes, but I don't think that Paul Mashatile, I don't think his election as ANC president is as important as previous ANC presidential races, which we have followed so closely. And why is that? It's no longer a proxy for who will be president of the country. It may be so for one more election, but unless the ANC doesn't rapidly pick up Gauteng and specifically Joburg and Tshwane, big problems for the ANC. This is where the bulk of their supporters live, and you cannot run a place like Gauteng is to all intents and purposes a failed province if it wasn't for the private sector and for those of us who keep things going via WhatsApp groups. You simply can't, and we do, I can see you all on those WhatsApp groups. You can't run big cities this way. You can't treat citizens this way and not expect that they're not going to retaliate. The ANC only got 34% in Gauteng last year, you will remember. If the trajectory continues, that goes down. 20% is not impossible if the conditions of our cities, the 3 cities in Gauteng, don't substantially change before the next local election, which is the end of 2026 or early 2027. I have 6 minutes, I must hurry. So not so big a story, old JZ, anymore. Hey? He was the story of the election last year, 14%. First time a startup party ever wins some double digits like that. MK becomes the official opposition, but now they're just fighting like hell. Hey? Mzwanele Manyi, the chief whip, was fired. It looks like Floyd Shivambu, the big, they parachuted him in from the EFF. He's on his way out. So it's self-immolating in factionalism and drama, and it hasn't really cohered. The EFF is filling that space as a decent opposition, if you saw them in Budget 3.0, and also today with the fuel levy and on the lottery license. So they're becoming an interesting opposition to watch. So very quickly, I'm going to go through the polls. 4 sets of polls. What are they showing us? This is Brenthurst. This is the Brenthurst Foundation, but modeled for 58% turnout. This one is the Institute for Race Relations. People got excited for this one. I'll show you why now. Because it suggested that the DA and the ANC, if you look at the red bars, that they were pulling quite close to each other. They modeled for turnout here. So I asked the Social Research Foundation, which I think is very good, what are all these polls telling us? And Gabriel, who works there, said that the most important message to take away from the 4 sets we've seen this year is what we have is an ANC coming down to 40%, even though it bumped up because we all like the GNU so much, and it did quite well in some by-elections, and the DA trying to touch 40%. The biggest messages are that we never have a majority government again, and what we should think about is the shape of coalitions and of power sharing. I don't see right now that we will have a radical government of national unity with the EFF and MK in it, but that could change. All these polls are showing us is we're in a different kind of landscape right now. So very quickly, something I don't think we give ourselves credit for enough is the power of soft power. And as Joseph Nye, the philosopher, late philosopher, wrote, a country's soft power is often as powerful as its hard power, its GDP, etc., its trade relations. And I think South Africa, we undercut ourselves in thinking about how beautiful we are and how many people want to visit. So I'm sure you've noticed this. The Kruger manages to be 110, 120% full. I'm not sure. Chris can explain to us how that happens. But people loving it. Mpumalanga benefits. And Cape Town is just booming. I'm sure you've seen when you fly there, visit there. People from China, from India, the rest of Africa, including the normal markets, are just piling in here. We're cheap and we're also a bit of a safe haven. So this was the chainsaw guy. I felt it was like, I know many people at Daily Maverick, they write to me, they love Elon Musk. He is very clever. The Tesla's beautiful, Starlink's interesting. But I think this was an image of cruelty in the way that people were taken out. And I think it's why his job, his term at Doge ended today. Many images of hate that I've been just picking up. This was a lawmaker in Uganda as they began to pass all these anti-gay laws, anti-LGBTIQ laws. And here's us. This is how we know ourselves. Diversity, equity, inclusion of everybody, all communities, written into our constitution, a very important part of what South Africa is. I know we have other stories, and people realize this. Our flat accents, like mine from Bosmont, is apparently well in demand because we are one of the best places for call centers in South Africa. I mean, people, you must see, my husband over here tells me some stats about how people opening call centers. This was the other week in Cape Town. And Jordan Hill-Lewis regularly puts out press releases, so it's very big. This is in the Waterberg Airbnb training our guides because they can see how many people are coming here. And then our soft power.
The complaint about Trump is that he's unpresidential, and it stems from certain statements that he's made.
When Mexico sends its people, they're bringing drugs, they're bringing crime, they're rapists, and some, I assume, are good people.
And you know what they say, when you assume, you're the best at assuming. Trump. I know these comments about immigrants were upsetting to some people, but for me, as an African, there's just something familiar about Trump that makes me feel at home.
The influx of illegal migrants, crime, unfair business practices, drugs. It is also not true that all foreign nationals are involved in criminal activities. There are some who are, but not all of them.
I love how we all wait till
So Trevor's not talking this in the second term. He'd be home by now.
African President Jacob Zuma sounding...
Anyway. And then there's, of course, the fastest teenager in the world.
I've never felt like
Isn't
this.
it just
before.
wonderful?
Respect elders. So for you to focus and be strong, that's the only way. That's the only thing that will push you. And also faith. Have faith in yourself.
We
Have
turn them
faith
out
and you
all
make it
the
in life.
time.
Gracias, Lima.
And then finally, this lady. You all know Tyler, right? Okay, my thing says time up. Thank you very much. Chris, would you like to come up now?
Okay.
Thank you.
That's great. Evening, everyone. I hope to be half as entertaining. That was brilliant. Thank you. I want to be quite brief. There's only two key points that I want to cover in this presentation. The first is having a look at what's happening globally, particularly in the US. And the second, we're going to have a look at why one should bother at all looking at South African equities. So it's got with an investment mind, with the focus. So we're going to start off with what's happening in the US. Now, clearly, it's a very volatile time. There's a lot going on. But a lot of it we can understand if we take cognizance of this particular chart. And what this chart shows is the interest bill for a range of countries. We've got the US, France, Germany, and Japan as a percentage of GDP. It goes back 60 years. Now, for most of those 60 years, the US's interest bill as a percentage of GDP was very similar to its developed market peers. And then about 10 years ago, in Trump's first term, that started to diverge. And what happened was that the US embarked on an expansionary fiscal policy in an environment where the unemployment rate was low. It's very unusual. Countries don't typically do that. And the rest of the world didn't follow the US example. So the US got a boost to growth, US exceptionalism, got a boost to the stock market. It's because they took on a lot of debt. And now they're at the point where their interest bill is over $1 trillion a year. It's more than defense. It's 4% of GDP. It's a problem. Now, there's not many ways you can solve a problem like this. You can hike taxes. He doesn't want to hike taxes. He can't. It's politically impossible. You can cut expenditure. But it's entitlements that are the large portion of US expenditure. You can't easily cut expenditure, not if you want to be in a party that's going to be re-elected. You can kick the can down the road. But they've done that already. That's how they got to where they are. It doesn't leave many options. So you need to raise revenue in some way. Tariffs. So the tariffs aren't just about trade. It's about trying to find a way to solve their debt problem without losing too much electoral support. So he's got a few problems here because the tariffs will lead to lower growth, and now they've just been binned by the courts. So they've got to try other ways to try and do it. But this is the underlying issue in the US. They've got a debt problem. Debt to GDP is above 100%. In South Africa, it's 75%. They've got a problem. That's also why he puts pressure on the Fed to cut rates, because he wants to be paying less in interest. Now, if we take cognizance of that, it explains why they've got the tariffs. It explains why they were going down the Doge path, unsuccessful as it may have been. The attempt was to try and control government expenditure in a politically palatable way. But to do this, they're breaking things. They're breaking things. You can see it through the tariffs, and it's led to reduced consumer confidence in the US. And we can measure this in a number of different ways. There's a range of surveys. The great thing about the US is that there's a survey on everything. There's data going back 50 years on most of these surveys. It's amazing. You can find out literally any piece of information you want. It's freely available. These are a couple of surveys measuring consumer confidence in the US, and you can see the latest part, big dips. 2 days ago, one of these surveys was updated, and there was a slight uptick, but the general trend is of decline. And you can ask consumers, as part of the survey, because you've got all this information in the US, what are you most upset about? And first and foremost, consumers are most concerned about the prospect of losing their jobs in the next 12 months. In America, a country with the unemployment rate around 4%, they've managed to frighten their consumers through Doge and other sort of actions. That's damaging. If you as a consumer think you're likely to lose your job, it changes your behavior. But secondly, they're not just worried about their jobs, they're worried about inflation. The average American believes that inflation next year will be around 6%. It's 3% in South Africa. So if you think as a consumer now, there's a chance I'm going to lose my job, and there's a chance that inflation is going to be 6%, what do? You say, if I'm going to buy stuff, I better buy it now. I'm not going to be able to buy it later. So Q1 GDP growth was actually very good. Consumption spiked, imports spiked. Consumers got all the stuff they need to get because they're battening down the hatches. And we need to be prepared for a slowdown in growth in the US. It's different from what we've seen in the last decade. The US has been the center of everything because of their debt binge. But now they've got to pay the piper, and they've got to try and figure out how to do that. And that theme, we think, is a key theme that's likely to be driving markets across the globe. Now, it is important to note that this is a US problem in particular. Other countries didn't follow that path. Other countries don't have to go down this tariff route. The retaliatory tariffs, where they're doing it, is a defense mechanism. They're not trying to raise revenue. The US is. So when you look at changes to GDP forecasts, and this chart shows GDP forecasts for the whole of 25 and 26, for the same countries I showed earlier. When you look at changes to forecasts, the changes have been focused on the US. It's very different from what we've seen in the last decade. We're seeing downgrades to US growth, not downgrades elsewhere, except for maybe South Africa. Now, this is significant. It's significant because it matters for the stock market and it matters for currencies. Now, you would think in an environment like this, with all of the uncertainty in the US and the difficult problems that they face, which are US specific, related to their debt problem, you would think in that environment that the dollar would be weak. And it's not. The dollar is strong. This chart shows the trade-weighted, inflation-adjusted dollar. So we look at the dollar versus the renminbi, the euro, the rand, everything. And we weight it accordingly by the amount of trade done with each country, and we strip out inflation differences. Up means strong, down means weak. The latest weakness that we've seen in the dollar, that's the little rounding error on the far right. Outside of that move, the dollar is the strongest that we've seen in 50 years, while all of this is going on in the US. Those are two things that are very difficult to reconcile. The market, for whatever reason, is still giving the current administration a lot of credit. They're seeing the debt problems, they're seeing everything else, but they're saying they'll get out of it. This time, they'll manage to escape. And that's a problem. It means that there's very little margin of safety in the dollar. And while the dollar might remain strong for the next few months because it's a volatile period and people like holding dollars in volatile periods, and that might mean the dollar remains strong, the next few years are likely to be characterized by some form of dollar weakness. The US is going to pay the consequences of their debt binge. It's simple. If we did the same, follow the same path, we'd have exactly the same thing, except it would have happened sooner. So it matters for the currency, and you would think it would matter for the stock market. This is forward PE ratios for a range of stock markets across the globe. The US, despite everything I've just mentioned now, is on a forward PE of 22 times. It's at a 25% premium to the 15-year median, its own 15-year median. So the US is expensive relative to all the other countries you look at, and it's expensive relative to its own history. Now that's difficult to reconcile with what we just said. And part of the reason it's expensive is because there is still an element of optimism with regards to earnings forecasts for the US. There's a belief that corporates will be able to ride through this, to the extent that the current consensus forecast is that earnings growth over the coming year will be about 10%. Now, 10% is where it is at the moment, and that's off a high base. So it's grown, and even though the economy slows, it's expected to grow again. That for us is a concern. It seems, again, like there's very little margin of error in a call like that. If we look at other countries, they're all trading in multiples roughly similar to where they were before, except, again, South Africa. The South African stock market's on a forward PE of just a bit above 10. That's cheap relative to the US, less than half price, but also it's cheap relative to our own history, 15% discount to normal. So we look at global markets and we allocate across global markets and we take into consideration a number of factors. But the ones I just mentioned now are pretty important for us. And that's not to say you should disinvest completely from the US. You can't. It's 70% of the developed market index, it's 50% of the global market, and the best companies in the world still at this point reside in the US despite their issues. But what it does tell us is that we do need to broaden our net. We can't simply rely on the Mag 7 in the way that we might have been able to do so for the last decade. We need to go look at the granolas, which are the top companies in Europe. We need to have a look at the top companies in China. We need to look closer to home to find opportunities, because the next 10 years are likely to be different from the past 10 years. So that was my first point on the US and why we need a bit of caution when looking at that market. The second is on South Africa and the opportunity that is present here. It's difficult to sell that argument. It's no shortage of bad news with regards to South Africa. We all read the press. But what I'm going to show now are a couple of mini themes which provide a set of supporting factors for the local market, or in some cases, headwinds for other markets. And to start off, we've got to take a step back. We're going to have a look at the globe. This chart shows fertility rates for every country across the globe. It's data from the United Nations. They put out a report every 2 years. The last one came out June last year. And what one can see is that about half of the globe has a fertility rate that's below replacement. So you need 2.1 babies per woman to keep your population stable. Half of countries don't have that, which means in time, absent immigration, those countries will see their populations decline. You can see where fertility rates that are high are clustered. Quite clearly the case, all in Africa, pretty much. A couple of countries in South America, Afghanistan, but it's Africa. The future, unequivocally, believe it or not, is African. And we can see it through fertility rates, and fertility rates give you a good guide for where populations are going. And if you look at UN forecasts, at the moment, the African population accounts for 20% of the global population. By 2100, the UN thinks it'll be 40% of the global population. 40% of the globe is going to reside in this continent. That is going to have massive macroeconomic consequences. First and foremost, if we look at working age populations, the key advantage that China has was the largest working age population of any country. And they used that to their advantage. They were able to build the ports and infrastructure to allow the people in their country to work, and they had the most number of people that were able to work, and the world invested. And they worked, and they made stuff, and they sold it everywhere else. China's working age population is just about to overtake, India's working age population is just about to overtake China. 10 years' time, Africa, again, you shouldn't call it a country, it's the whole continent, but in 10 years' time, Africa's working age population overtakes India, and then look what happens. To the extent that labor is going to require laborers in the future, and maybe it won't, maybe they'll all be machines, and maybe Elon Musk will get it right. But if we do need people to go and work in factories, those people are going to be in Africa. And the private sector will build the ports and the railways and everything else to get to the people so that those people can work. This is a massive opportunity, largely unrecognized. It's also a risk. You're going to have a huge working age population. Will you have enough work for those people? Will it lead to unrest? This is going to be the defining question for the African continent over the next 50 years. We need to do the ports and the railways and everything else to ensure that there is sufficient work for what is going to be a burgeoning population, or there's going to be big problems. Anyhow, so what we can do is we can say, all right, what countries across the globe don't have massive demographic headwinds? What countries across the globe have a birth rate that's above replacement and at the same time have an equity market that we can actually invest in? So a market cap above $100 billion, which is not very big by market cap size. There's 4 countries in the world that have investable markets and a fertility rate that's above replacement. That's it, 4. It's Saudi Arabia, South Africa, Indonesia, and Israel. They're ranked by order of market cap. Saudi Arabia is bigger than South Africa, which is bigger than Indonesia, which is bigger than Israel by share of market, or by total market cap. Saudi Arabia's market is a play on oil. It's Aramco. Israel's market is a play on tech. So actually, there's 2 countries in the world that have a fertility rate above replacement and an investable market. That's not necessarily going to be an advantage for us because we've got to get it right and we've got to provide the jobs for the people to work. But it is a risk for every other country that we invest in. US, Europe, China, they've all got demographic headwinds that they're going to have to resolve. They say, oh, you resolve it by immigration. Well, that's a political problem that you have to fix. It's still a problem. So this headwind for the rest of the world is absent here, and we're one of the very few countries that doesn't have that problem. We've got a lot of other problems, but we don't have to worry about that one. The second thing I want to look at is something that typically raises an alarm, which is the investment rate in South Africa. This shows gross fixed capital formation as a percentage of GDP. So how much are we putting into buildings and factories and dams and the like as a percentage of GDP? We're the yellow line. That number at the moment is about 14% in South Africa. The other countries are developed market peers, and they range from 20 to 30. So they invest a lot more than we do. If I were to put some emerging markets in there, like China and India, they would be at the top end or off the chart, 40 to 50% of GDP on investment. We don't invest a lot in South Africa. And I mean we. It's everyone. The private sector doesn't invest, government doesn't invest, no one really invests. And that leads to problems. The direct consequence is that there's low growth in South Africa. And everyone focuses on the direct consequence. The indirect consequence, though, is that there's less competition for the incumbents. Think of Starlink as an example. Starlink comes in, it means more competition for the incumbents. It's not necessarily going to be good for some listed companies in South Africa if it does come. It'll be good for the country. It'll be good for GDP growth. It won't necessarily be good for corporates. It works the other way around as well. If foreigners are not coming, if foreigners don't want to invest, it's an environment which is quite helpful for the incumbents. If South Africans don't want to invest, we don't compete enough with each other. And the best way to show this is that return on equity in South Africa for South African corporates is regularly above the other countries. There's a simple reason for that. We don't invest because we demand a higher return in order to invest, to compensate us for the risk. If you're going to invest in South Africa, you want 15% return on your project or more. If you're going to invest in the US, you might want 8. The point out of this is the incumbents enjoy a very high return on equity in South Africa. Now, how is that relevant? Well, South Africa is one of the top 3 performing stock markets in the past 120 years, believe it or not. It's not because of growth. South African growth has rarely been exceptional. We think it's because of this. Return on equity, return on capital. The incumbents do very well, so you can get access to that through the stock market. Now, the question is whether that's priced in or not. So this chart shows the median return on equity for shares in the South African stock market compared to the price to book, how much you would pay. In most countries across the world, ROE higher equals price to book higher. You pay more for higher returning companies. Makes sense. South Africa is an exception because not many people have faith. The ROE in South Africa for companies is good. It's 18%, the median. Price to book is about 2. Same as Europe, same as the UK, half of the US. We showed PEs earlier, we were half the price. Price to book, we're half the price as well. Despite our earnings growth this year actually being greater than the US, and our return on equity this year being greater than the US as well. So that's the second reason to bother looking at South Africa. Things are cheap here. They're cheap because we demand high returns in order to invest. And as a result, we typically get high returns over time. The third reason relates to this morning. We got a rate cut. Unfortunately, just 25 bips. Hopefully there's more to come. The chart on the left shows the inflation rate in South Africa. It's currently 2.8%. We're not quite sure what the SARB's target is at this point. It was 4.5. At this morning's meeting, they hinted they're going to be looking at 3, leads to some confusion. I'm not sure what they're going to be doing. But whatever their ultimate goal is, if you look at the chart on the right, that's the difference between the repo rate and inflation. The gap in South Africa is 4%. That is penal. You will not find many countries across the world that have an interest rate that's 4% above inflation. Typically, a reserve bank would do that when they're trying to cool the economy down at the risk of causing a recession. We have very high interest rates in South Africa relative to inflation and relative to peers. There's ample opportunity for further rate cuts. We had 25 today. Over the next couple of years, and they might do it slowly as they try to figure out their inflation target, we've got scope for material downside to rates. And that should provide impetus for South Africans, because South Africans, at the best of times, do not save. We don't. At the height of the global financial crisis, the saving rate for South Africa was positive for 1 quarter. And then we went back to spending. So you cut rates in South Africa, the first thing that South Africans will do is they will take on debt and they will buy a car. We've got the data, it goes back 30 years. It happens every single time. The next thing that we will do is accessorize the car. We will get better. Then there's a couple of other discretionary items. The fourth or fifth one down the line, we will drive the car. Fuel prices, we will actually spend more on fuel when we get a rate cut because we will take the car somewhere. We'll go on holiday with it. Then you skip another 10 items or so, another 10, and then you get to education. Right down at the bottom. It's terrible, but it's what we do. We're predictable. If nothing else, we're predictable. Cut rates, it adds to growth. And that too provides reason for optimism and potential spend in South Africa. The final point I want to make on this is that we do have a natural disadvantage in South Africa, despite these tailwinds, despite the fact that we don't ever back ourselves and no one backs us either, and even if we just skirt disaster, that does better than everyone thinks and we get a positive return. Despite that, we do have a natural problem, and the problem in South Africa is that our equity market is very concentrated. Now, we complain about the Mag 7 and how concentrated the US is. If you take the top 10 shares in the US, it's 35% of the US market. That's a lot. Take the top 10 in South Africa, it's 75%. We have a massively concentrated market in South Africa. And that enables us, or not enable us, it forces us to have to look outside the index if we're going to try to take advantage of some of these tailwinds. We can invest in the index, you can do it quite easily. But the problem is, A, you're getting exposure largely outside of South Africa, but B, you're taking on an index which is extremely concentrated by global standards. So there's a requirement almost to scratch and sniff and have a look around outside of the counters that sit in the top 10. And Farrell, that's it for me. I'm going to hand back to you. Thank you, everybody.
Thank you so much, Chris. That makes my anxiety levels go down, and I'm about to put in an order for that Golf GTI souped up version, or maybe an Omodo. Now for our fabulous panel. This is the meat, and all your questions will be answered here. May I introduce Ryan Friedman, the head of multi-manager investments and the lead fund manager for Investec's global multi-manager range since 2002. Very welcome. Tabiso Masiela, the co-head of Investec My Investments, who curates your offerings for your clients. Welcome. Bronwyn Trower, Investec's co-portfolio manager on the Investec BCI Active Income Fund of Funds, and much else. I very much look forward to our conversation this evening. So, Ryan, I'm going to start with you. We saw the word cloud from the audience here. These were the words you used to describe your feelings. how do you, it's very noisy out there and you can feel people feeling vulnerable. So how does your investment approach rise above that noise, and how do you think you do things differently?
So at the heart of our investment philosophy is this concept called investment reductionism. Now, investment reductionism is based on the Pareto principle that states that 80% of consequences arises just from 20% of causes. Now, of course, it's the good old 80-20 rule that we all know so well. But investment banks and asset managers hate this concept because they seek to complicate investments in order to raise more money or to sell more product. Our role and our philosophy as a team is the exact opposite. We look to simplify investments and to focus on the few super drivers that really move the needle and to call those right. And implicit in this investment philosophy really is a view to long-term investing, a focus, an obsession to some extent with long-term investing. And you asked me how we do things a little bit differently, so let me elaborate on 3 areas that I think we do things a little bit differently. First and most importantly, we invest with people, not systems or processes or historical return streams or spreadsheets. You know, I've been in this industry for 25 years, and it's fascinating to me, it's ironic to me, is what I always say. How many people in our industry, in their endeavor to build a forward-looking investment process, rely exclusively on historical returns? That doesn't make much sense to me. We think the best way to understand both the reward and the potential risk of an investment is to understand the people behind that investment, because it's people that make investment decisions, not spreadsheets. So we spend all of our time, all of our good time, traveling literally to various parts of the world, doing due diligence on fund managers, the funds they run, the teams that run these funds, and understanding the people behind the investments, the people behind the process, and that's really across the asset class spectrum, whether it be equities, shares, fixed income, listed real estate, listed infrastructure, or absolute return funds. And what we're trying to understand is who is the best money manager, the very best money manager in the world at managing Japanese equities or European bonds. When we're not analyzing investment managers in their offices, what we are doing is scouring economic research and strategy research, not for the sake of economics, I'll leave that to Chris and to the other economists and academics, but in order to understand the direction of travel for financial asset prices, right? It's very important for us to understand the direction that asset prices move based on a particular market environment we're in, whether that be where are we in the business cycle, or what does the macroeconomic outlook look like, in order to position portfolios to take advantage of the tailwinds and to guard against some of the headwinds. You know, Wayne Gretzky, the great Canadian hockey player, ice hockey player, said a famous thing. He said, move or skate to where the puck is going. And this is how we think about asset allocation. We want to position the portfolio to be able to benefit from for certain tailwinds in a particular economic environment. And then the last thing I think that we do slightly differently to the rest of the industry is our view of risk and our quantification of risk. And what we don't believe is that risk can be adequately quantified by statistics alone on a piece of paper. Risk is a much more holistic pursuit. One needs to understand risk both qualitatively and quantitatively. You know, I used to run a hedge fund of funds for the bank many years ago, and if there was a little clause in the prospectus saying you can't get your money back under these circumstances, that constitutes risk. Unfortunately, our industry is obsessed with textbooks and the academic definitions of risk, which are important, but they don't constitute the full gamut of what risk is. So we think about risk qualitatively and quantitatively, holistically, and in that way, we try to build portfolios that smooth the return stream over time and deliver superior risk-adjusted returns.
Thank you. So somebody was chasing a very expensive puck on Tuesday evening in Houghton at Strauss & Co. Somebody paid 27.6 million rand for the Trechikov, the Oriental woman. I'm sure that many of us had them prints of it in our homes, right? So there's obviously a cautious optimism out there. And I'm wondering if you're feeling it, firstly, and secondly, is it yet a part of your strategy?
So I think one, once again, needs to look through the cycle and take a longer-term perspective of where we are and kind of what's going on. There's a lot of noise out there. Chris alluded to it. within politics, within geopolitics, within policy from central banks around the world, macroeconomic data. So there's a lot of noise out there. And one needs to take a step back and say, okay, what is the short-term noise and what can we decipher long-term? Because ultimately, people have become obsessed with trade and tariffs, as Chris correctly pointed out. The question really is, what is the market pricing based on the current narrative? And our view is that the market isn't attaching sufficient premium to some assets for the risk implicit or inherent in what's going on globally. Think about trade for a second. So you have an environment where the stock market is increasingly volatile. Every time President Trump opens up his mouth, the stock market moves up or down by a few percentage points. But behind all of this, we think there's a lot more going on than just what's going on in the tariff front. In fact, even before Liberation Day, which was the 2nd of April, the greatest imposition of tariffs in the last 8 decades, as long as any of us have been alive, actually the US economy was slowing to some extent, right? And what do tariffs do? They serve as a tax to the consumer, and they serve a tax to economic growth. And so ultimately, if you have a slowing or vulnerable economy, a shock that is imposed by tariffs really might ultimately do some extensive damage to an economy that looks already a little bit vulnerable. And to that extent, you would think that company margins would need to come down. You would think that valuations should come down and that earnings should be affected. But as Chris correctly pointed out, consensus bottom-up earnings expectations for the next 12 months of the US equity market are around 12%. We find that interesting. Go back to 2018, Trump 1.0, right? There was tariff imposition, which was around 3.5%, a bit over 3% on an effective rate. Yes, it was uncertain or unexpected at the time, but at that point in time, you had the Fed funds rate, which was 200 basis points lower than it is today. The market fell by 20% and earnings basically stagnated. Fast forward to 2025, you have the largest tariff imposition, as I mentioned, in 8 decades. Fed funds rate is 200 basis points higher. The market is pretty much close to its all-time high, and the consensus bottom-up earnings expectations are for 10% growth over the next 12 months. That doesn't make a hell of a lot of sense to us. So we would be cautiously cautious, if I can say that, Viral, and we would think that one needs to build a defensive portfolio that is positioned for multiple outcomes and has a number of hedges in place.
Fair, thank you. So, Brandon, I can imagine how your Bloomberg or Reuters terminal blows up every day, right? This world is changing so quickly. History is being written every day. Multipolar world developing in front of our eyes. Are the watchwords of long-term and steady growth, are they still your North Star? Can they be in such a world?
Definitely, and I think, we forget about it, but when it comes to the markets tend to play on our sort of emotive side of things. If I can use an example, sometimes we'll go, we're holding the share and we've bought it, and, when do we sell? So that, and often sometimes when I talk to friends, they go, I've bought the share and it just keeps running, so I'm just going to ride it out because I want to eke everything out. Or the share falls and you go, no, but I've got that point to reach again, so I'm just going to hold on a little bit. So that really does play to the greed part of things. On the other side of things, sometimes when you're not holding a share and everyone is talking about it at the braai, you want to get in. So it really talks to that fear of missing out. So the point I'm making is that the markets often work on our fear and our greed receptors. Now, at the risk of sounding cliche and quoting Warren Buffett at an investment showcase, he said something where he says, price is what you pay and value is what you get. So what we try and do here as sort of a multi-asset team is we try and look at the markets and go, what price tag should be assigned to this asset at a point in time, to what Ryan was saying. And we know pretty much that if the future value and what we think the future value of that asset might be is greater than what we paid today, we're generally on the right track. So at Investec, when we look at the way the investment business does things, the multi-asset team will go, right, we are responsible for the asset allocation, and we're also responsible for the bottom-up investment. So what does that mean in English? It's a phrase that I like to call team and theme. So what we end up doing when it comes to theme is we look at what's happening in the markets at this point in time, and which areas, like Ryan mentioned, Japanese equities or European bonds, do we think are attractive and why? Then when it comes to team, we think that we really do find the best managers, the best fund managers in the world who are good at, say, for example, stock selection when it comes to Japanese equities. So you as our clients on that long-term strategy can really sleep well at night, because what we're trying to do is we're trying to ascertain what is the best theme to invest in today, what price are we paying for that asset, and then when it comes to investment selection, who are the best managers at that particular area of expertise. And I think this element of team, Ryan's spoken about it, it's so different to the way that we think we do things that I do, if you don't mind, Farrell, I just want to rope Ryan in just to maybe talk a little bit more and bring that element of team to life on how we've dealt with one of our managers.
Sure. So I'll give you an example of the people element about what it is we do. In 2008, we made an investment into a deep value manager, someone that buys stocks that are trading at a very significant discount to what he constitutes intrinsic value. And we thought he was truly a brilliant bottom-up fundamental stock picker in that space. He works at a business in Los Angeles, and by the time we had disinvested from the fund, he was outperforming his internal benchmark, the MSCI All Countries World, by an excess of 40%, a truly remarkable achievement in a very volatile environment. He then left that business to start his own business a year or two later. We disinvested every single cent post him leading that business. Interestingly, actually, we gave him his first $20 million to start what was a European, essentially marketable fund. He was only marketing into the US. That fund grew to $2 billion. He then left the business to start his own business, and by the time he left, or soon after he left, $40 billion of that assets under management walked out the door. The bottom line is he started a new business in 2013, and we invested with him. We were one of his early investors. He had no track record in the new business, and often people will say, well, I can't invest with someone who doesn't have a 3-year track record or a 5-year track record. We knew the person. We invested with the person. We were comfortable with him. We thought he was one of the best risk managers in the world, one of the best stock pickers in the world. And I'm pleased to say that in 2016, I think it was, he was pretty much the top performing global equity manager in the world, producing a return in dollars in excess of 50%. We still have a significant amount of our investors' capital invested with him, and this year he's up 22% in dollars. But the point I want to make here is not how spectacular his returns have been. The point I want to make is understanding people, how they run their investments, what their biases are as individuals, in what environment will their fund do well, in what environment will their fund do poorly. And then if we understand the macroeconomic environment and the direction of travel for the macroeconomic environment, and we truly understand the fund managers we invest with, then we are able to marry those 2 points and allocate capital to the right people, hopefully at the right point in the cycle.
Thank you so much. That's important to know, because a lot of the questions that came in was, should I be getting into cash now? People are feeling nervous. That's what we do. So a big question for you, Bronwyn. Can you walk us through quickly and any number of your funds that you deal with? I know you have something to show us.
Perfect. A slide will come up in just a second. But maybe just on the element of cash in your portfolios, I'll start with the last part first. That is an important element. And when you talk to your advisor, you'll sit with your advisor and go, this is the portion of cash that I need to hold for my specific needs. But like Ryan and I have just explained, we think that the way that we've set up our multi-asset funds does take care of everything else for your investment needs. So the slide that you'll see come up, and when you do have your conversation with your advisor, they'll take you through this again. What we're showing you here is our 4 offshore funds. And what you can see is the funds move from what we would call the most conservative to a little bit more aggressive. And you'll see in the little bar charts by the color blue, that's denoted by the amount of equities we can take in that fund. So you'll see if we move right across to what we call the Global Equity Fund, that fund can take up to 90% essentially exposure in equities. And that's because when we think of the markets, equities are supposedly the most risky asset. So I think a few things to point out over here is you'll see at the bottom in gray, what we're showing you there is though these are daily dealing funds, you can get in and out literally every single day. is when you have a conversation with your advisor, they're likely to talk to you about a time period. So the first two funds, the more cautious funds, or the more, we've got cautious and core over there, less aggressive funds, that has what we recommend an investment time period of 3 years. Whereas you move across to the more aggressive funds, you've got the flexible fund and the global equity fund, that has a recommended time period of 5 years. So as an example, my husband and I, we have a little 1-year-old, and we've put him in the global equity fund because we definitely don't want him, if there was a 30-year tag on that, we would say don't touch that money for 30 years. I think the second thing to point out, these are truly offshore funds that we're showing you on the screen. So a lot of you had concerns about how do I externalize funds? I want to be sitting in dollars. This is dollars in and dollars out. But we do have the ability, we call them feeder funds, to be able to access these in rands if you want. And I think, again, when we're reading all these headlines, everything Ferial's talking about, what Chris and Ryan have mentioned, if you look at the flexible fund, say, for example, you can see there, sorry, if you can go one slide back, you can see there that the equities can go from 20% to 90%. And there have been environments where we've taken equities in this fund up to 85%, and not too long ago, we've taken equities down to 25%. So if you're worried about the markets, this is sort of a one-stop solution that we think takes care of all your needs. You can go across now to the local slides, because as Chris mentioned, we sometimes forget about South Africa, but we do have 3 local funds over here. When talking about cash, you're likely to see that first fund over there, it's the active income fund. That fund aims to beat cash, and you'll see when you talk to your advisor again, you'll see the time frame over there talks about, even though, again, you can get in and out every single day, there's a hold period there or recommended investment horizon of 6 months to 3 years. And then our more aggressive South African funds over there, being the balanced fund of funds, the diversified growth fund of funds, again, can hold a lot more equities. And, Chris had mentioned it, and it's nothing to scoff at. We often look at our, the issues that we see in South Africa politically. We look at what we've seen in the US, and we go, well, definitely my money should be offshore. And there's a time and a place for that. But if we just look at the returns in South Africa, and we look at the top 40, which is our obviously top 40 shares in South Africa, if you looked at the returns from yesterday and you looked a year back, despite everything that happened with the GNU, everything Trump has called us to order for, that market, or the top 40, had delivered in dollars 26%. That's incredible over the last year. So fine, you go, okay, Bronwyn, that's equities. What about bonds? Because they're supposed to be less risky. Again, the South African market, proxied by what we call the All Bond Index, really a proxy for duration assets, so bonds, that delivered over the same period 23% in dollars, right? And then we compare that to what we all talk about, the S&P 500, the US market. Over that same period, the US market delivered 11%. So again, there's a time and place, and again, when you have a chat to your advisor, they'll be able to guide you a little bit more regarding your needs and investments.
Thank you very much. Lucky son.
Hey?
So, Thabiso, very welcome. So, lots of people were asking us about retirement and about how to care for the next generation. How are you thinking about these things?
Retirement, and I guess when you start talking legacy issues, that can mean many different things for different people. Ultimately, it's really based on your objectives, your aspirations, and being able to marry that with your value system or your values that you're trying to achieve. Our approach in that regard, when it comes to retirement and legacy and being able to leave something for your loved ones, has been around firstly understanding what those aspirations are, what those objectives are, and at the same time, understanding what you've been able to accumulate to date. If we speak financial advice, that's a very important exercise to do in terms of understanding what a person has achieved and also what they're trying to aspire to. Once you've been able to do that exercise, I think our financial advisors will also tell you that it's an extremely valuable exercise, but at the same time, it can result in tough conversations. And in terms of those tough conversations, it's really how do you achieve your objectives, where are the gaps, and how do you start changing your behaviors in order to achieve your lifestyle requirements over the long term. And obviously, once you've been able to get to your lifestyle requirements, then you can also start now preparing and ensuring that you're able to leave something for your loved ones.
What do you offer in the way of education? Because lots of people say, where can I find this? How do I know more?
I think, again, the approach that we've taken is we understand that a lot of these concepts can be quite complex. And in that regard, we've been quite deliberate in ensuring that in terms of our communication, in terms of how we've put our offering together, that we are very clear, it is simplified, and we're speaking in English rather than the Greek that people see when it comes to investments. The other thing to consider is, I think in this day and age, we all live very busy lives. We've got our day jobs, and we're not expecting people to become investment professionals, even though they understand the importance of investing and saving. And something else that we've included is in ensuring that we can meet our clients and communicate with our clients in a manner that they're able to consume information. So some of the things that we've done, or what you can expect as one of our clients, is our Investment 360, which is our monthly newsletter that speaks to market insights, thought leadership, but a lot of the content and a lot of the work that you do is deeply rooted in providing financial education. I think when you talk financial education, there's a great demand. People want to know what the money is doing, what the money is about, even though they're not becoming investment professionals. So I think when you look at the organization, not only in this investment business, we invest quite a bit in podcasts. There's a video series that we're also doing, and this is over and above the normal, your web pages and emails or any other material. So I think when it comes to education, it's something that we've been very deliberate about, and it's an area that we'll continue to invest in and provide additional resources.
Is it on an app or website, or how do people find it?
Look, I think if you go to the app, it's at a very high level. I think what we find when people deal with the app, it's more from a defined execution level. But obviously from a web process perspective, people tend to spend a lot more time on a desktop and the web. But as I say, the other things that we've been able to do and create is around podcasts. So that when you're driving or when you do have the time without necessarily having to do anything else, you can actually listen to a podcast and gain some information that way.
And are you the host because you have a beautiful radio voice? We're going to do some questions now. So I'd like to invite Chris to join us again. I hope that there'll be a chair for you. Thank you for our panel. Sorry, Chris.
Bring your own chair.
You're going to have to add that to your CV, Chris.
I think it's a health and safety.
It's a very
violation.
South African style. We do it ourselves. So
Yeah.
Thank you. So now we're going to just very quickly deal with some of your questions. And Chris, the first one goes to you. So AI has completely shifted my working life. And I'm wondering how Investec is thinking about the use of augmented or artificial intelligence in your investment decisions and in your strategy.
Yeah, thanks. It's a bit of a hobby for mine and a few other people in our team, so I'm grateful for the question. It's still relatively new, but we're doing a lot. So we subscribe to a couple of service providers, and the one I'm going to make reference to is ChatGPT Enterprise. So we've got a business subscription to it, and it makes sure that all of our data is sandboxed and doesn't get into the broader world. And it took a little while to get that all sorted out, but now that it's done, we've been testing it quite a bit. So as an example, an equity analyst, a researcher, would spend a lot of their time researching companies, and part of their job is to go find a new company, initiate coverage on a company. That's the process. So you've got to do all your research on it, come up with a recommendation, buy, hold, sell, whatever. So we thought, let's test this thing. So we asked it to initiate on companies, and we did it for each sector that we've got, and we sent those initiations to each of our equity analysts, and we asked them to grade it. And the grade was typically 9 out of 10 to 9.5 out of 10. It was good. Now, an equity analyst would typically take about 3 months to initiate. This thing took 20 minutes. So it's going to be a massive time saver for us. It's not to say we can replace analysts. From what we can see so far, it doesn't enhance the ability of the analysts. It doesn't make them more creative. But it does reduce a lot of the drudge work. It does a lot of the heavy lifting. It allows more time for thinking more deeply. So we'd hope to see a better result. But that's just on equity analysis. We've also trialed it out for macroeconomics. I did a presentation a little while back, and my calendar was pretty full. I had 4 presentations I was preparing for at the same time on differing topics. I was like, how am I going to do this? So I asked this thing. And it gave a result that was pretty good. It halved the amount of time they would have spent putting this presentation together. And we've tested it for a few other fields as well. So it's still in testing phase. We're hoping to roll it out more broadly, but the initial results are fantastic, and it looks like it's going to be a sizable boost to productivity.
That's really interesting. We could go on for long about that, but Ryan, I want to come to you now. So I hear you and Chris were in South America recently, scoping opportunities globally. We heard about the rest of Africa, which I certainly am watching. Where do you see the opportunities? And then to answer a question that I was surprised by is that people asked, should we hedge against significant market collapse? So there's two in that.
Okay, so let's start with the opportunities. Chris mentioned that the US market is expensive relative to its own history, relative to other markets. I'll just give you an indication of those valuation metrics. He mentioned 22 times forward earnings, and that US exceptionalism has peaked. We're completely on the same page when it comes to this. But if you look at the US valuation of the S&P 500, it trades in the 90-something percentile to its 20-year history. That means it's hardly ever been more expensive in 20 years. If you look outside of the US, the rest of the world, it tells a very different story. Europe, for example, trades at its median valuation to its 20-year history. Japan trades at its median valuation to its 20-year history. Emerging markets are, in fact, cheaper. If you think about Europe, for example, right, and if we write that US exceptionalism has peaked and that the US economic growth outlook will wane, will soften going forward, there should be a resurgence to some extent for the rest of the world, for the outside of US growth. Now, that's part of the reason why we think the dollar depreciates going forward. But if you look at valuations in Europe, between the period of early 2000s to early 2020s, Europe traded, which it normally does, at about a 20% discount to the US. And it's correct that it should trade at a discount to the US because you have some of the best companies in the US, some of the most innovative companies, some of the best management, etc. However, from 2022 to late 2024, that discount widened to approximately 80%. That doesn't make a hell of a lot of sense given the magnitude of that discount. Within Europe, for example, we think the banking sector is particularly interesting. So not only does Europe trade at a big discount to the US, European banks trade at a significant discount to the European broader index. Now, why that's interesting is because post-global financial crisis, the business model for banks have been changed significantly. Today, they're more like utilities. They hold a lot of cash on balance sheets. They have to meet capital ratios, and there's not nearly as much leverage in banks, which means they sit with a lot of excess capital, which they are using to buy back shares and distribute in terms in the form of dividends. They are very cheap. European banks, as I mentioned, trade at about a 50% discount to the broader European indices. So we like Europe, in particular like the financial sector in Europe. I'll just give a few, one or two other examples. Japan is a particularly interesting market for us. Corporate Japan today looks nothing like it did over the past 30 years. The macro environment in Japan has changed considerably. Japan was caught in a deflationary trap. Today, you're seeing broad-based inflationary pressures in Japan, largely as a result of wage increase. In Japan, they've got something called the Shunto wage agreements, which I think they have twice a year. The last wage round produced a nominal inflationary rate for inflation, well, a nominal wage hike of just over 5%. That's the largest nominal wage hike in over 30 years. So you're starting to see inflation re-emerge in Japan. So you're starting to see a more pro-growth environment to some extent, but certainly conducive to much more activity. And then if you think about corporate Japan, well, it's becoming a much more shareholder-friendly environment. The cross-holdings for corporate Japan or companies in Japan are being taken away. You're getting more independent directors on boards. You're getting companies starting to take over other companies in Japan, which never happened. You're starting to see share buybacks, and you're starting to see dividends being paid out. In fact, at a point not too long ago, 50% of all the listed companies on the Tokyo Stock Exchange traded at a discount to book, right? That means they had very, very poor capital allocation by management of Japanese companies. They're not expensive. Things are changing dramatically there, and we're starting to see a resurgence of M&A activity in Japan and a whole host of other things where foreign investors are becoming more vocal and demanding that corporate Japan changes. So I think there's yeah, we could go on about a couple of other interesting areas around the world, but that gives you two things to think about. The second part of your question is, should we hedge against the market collapse? Well, I think you should always hedge against unforeseen circumstances or outcomes. And two of our favorite hedges today are, in fact, the Japanese yen and gold. I'll touch on each of them briefly. The Japanese yen is a fascinating currency, right? The Japanese yen is the cheapest developed market currency in the world, trades at about a 50% discount to its purchasing power parity value, which, as far as I can remember, the last number I saw, the IMF estimated that it should trade at around in the 90s to the dollar. It trades today at 144 to the dollar. So it's at a 50% discount to what the IMF thinks the value of the Japanese yen should be. The Bank of Japan is the only developed market central bank that is raising rates this year, pretty much. And what happens is, because Japanese investors are such yield-hungry investors, they borrow in yen, which is a low-yielding currency historically, and they invest in higher-yielding markets around the world. If you get some kind of rate convergence, interest rate differentials converge because the US cuts interest rates and Japan is raising rates because you've got upward inflationary pressures, you'll have an environment where yields will converge and money will flow back into Japan, causing a significant tailwind for the yen. The other thing I would say then, when you have a risk-off environment, because a lot of Japanese external cash from households and corporates have actually been invested in US tech stocks. So when you have an environment where you have a sell-off in US tech or in risk assets generally, people repatriate those assets back into Japan. So you see a wobble in world markets and you see a strengthening Japanese yen. That's a great portfolio hedge in any portfolio. And actually, I think it's a great money-making trade. And then the last one I'll touch on very quickly is gold. Gold, we think, is a fantastic hedge too. Now, many people will tell you gold is expensive because it was up 26% last year, and this year is up close to 30%. It's come off its recent highs. But gold is typically driven by real interest rates, and real rates have been quite high, so you wouldn't think that would benefit gold. And the dollar's been quite strong, and there's an inverse correlation between dollars and the gold price. So what's going on? Gold has really benefited from massive central bank buying, particularly out of Asia and particularly out of China. So investment demand for gold is there, but it's not nearly as strong as central bank buying. That's propped up the gold price significantly as you see a whole lot of uncertainty globally in the political, geopolitical, and economic environment. But why do we still think that gold potentially has some tailwinds? And the answer is, we have an unstable geopolitical environment, good for gold. We have a very uncertain macroeconomic environment, good for gold. We think real interest rates will come down over time, good for gold. And we think the dollar will weaken over the medium to long term, good for gold. So there's two opportunities, two potential hedges in the portfolio, and yeah.
Thank you very much. That's 22 years of experience speaking there. Bron, very quickly, lots of people asking, what's a safe haven? Do you still consider bonds a safe haven? Ours have been doing pretty well.
It depends. So there's a saying that goes, the bond market never lies, and it's true. So if we think about not too long ago, you would and could lend to the German government, say for example, by buying German bonds, and you would give them 100, and instead of giving you 100 plus interest, you would get back less than 100. So in bond language, that only happens when there's a default, but the government didn't default. Then we look at US bonds, say for example, where sort of from 2020 to 2022, the US had raised interest rates from 0 to 5% really quickly. And then we started seeing the US bond market behave how we think bonds should behave. So, Chris has mentioned quite a bit at this point in time how we're looking at, say, the US Treasuries as a safe haven asset, is we're going, okay, if the US was a company and they took on a lot of debt, what would we want from them? We would want some sort of compensation in our coupon. And we're seeing that. Yields are remaining high. We don't think that they're attractive yet from our point of view in terms of this is the point to get in and go sort of full in boots up. But bonds can behave like safe haven assets, and again, you just have to be careful and think about it.
Thank you so much. And final word to you, Tabitha, your clients here, many, many questions coming from them. I know you outlined for us beautifully the range of products on offer. What else can you give them by way of not financial literacy, but advice about their portfolios in such a difficult and volatile time?
No, sure. And I think it's largely around that not everyone is an investment expert, not everyone is an investment professional. So in terms of the offering that we've been able to create, speaks to one, the funds, the range of funds that Bronwyn spoke about, from a local perspective to an offshore perspective. And what we've been able to do, as much as our clients have access to a full range of, give or take, 30-odd funds, we've been able to curate those funds in a way that can speak to the core needs of our client base. The other thing that we've got is the range of products. And from a range of products, it's really depending on what's appropriate, what the needs of our clients are, and what they're actually trying to achieve. And this is including from local, offshore, to retirement solutions, which are quite critical in terms of planning a portfolio, and including alternatives like structured products. The other important thing, I guess, as part of this is with us not expecting you to be the investment expert or the investment professional, is that you can actually engage in many different ways in order to achieve your goals. Whether it's from a self-directed perspective, we've invested quite heavily from a digital solution so the clients that are comfortable to use that mechanism, whether it's gaining some education or actually going out and executing across the full range of our funds, to having financial advisors. Our financial advisors are in-house, they're actually salaried employees, so they're not trying to chase any commission because we don't charge commission, nor do we charge advice fees. And I think those are important in ensuring that we can actually provide objective advice when you're sitting in front of a client. So ultimately, I think, let us do the heavy lifting for you, versus you trying to be the investment professional, understanding all the global markets, understanding which asset class we should invest in. Is it a good time to go in now? Where's the price sitting at? But rather pair yourself with a trusted partner that can actually help you invest based on your objectives and what you're trying to achieve over the long term.
Thank you very much, and thank you to all of you. To wish you well for the evening before food and drinks, Darren Berendt, CEO of Investec My Investments, will come and thank us all. Please welcome Darren.
Okay, so I'm going old school here. Well, you guys can stay here with your fancy marks. So yes, I think just in closing, I just want to thank everybody obviously for being here this evening. This is our inaugural event, so you guys are the guinea pigs. This is something we're hoping to do on a more regular basis, whether quarterly or semi-annual basis, so we're really keen afterwards to get a bit of feedback, understand what you enjoyed, what you didn't enjoy. I mean, there was maybe some periods where I thought I needed a bit of a drink. But I think maybe in addition, just to thank my colleagues, obviously for joining this evening. A lot of work goes into these kind of events, preparing, etc. To reiterate a little bit of what Tabiso said, and again, because this is our inaugural event, I think a lot of questions are often about, well, this is interesting, I may need some guidance, I may need some advice, I may, be looking to invest in certain things. How do I actually go about and do that? So I think Scott spoke about it a little bit earlier, and that is, I think from an Investec perspective, and it's not just from an investments perspective or a life insurance perspective, or a banking perspective, effectively, we understand that clients like to engage with us in different ways. Their needs may differ, and we look to cater for those. So I think the important thing is that there are many clients here this evening that may have financial advisors at the moment. They may need to speak to financial advisors. Tabiso did speak about our financial advisory team that sits alongside our bankers. So everybody here who's got a banker has got a financial advisor allocated to them. Those financial advisors can add an enormous amount of value to you. Like we said, from your perspective, it's a half-an-hour conversation. They can invariably, even if they don't change your mind around investing with us or anything else, I think they can add a lot of value through that conversation. And we find that that's very valuable for our clients. There's various ways of accessing our financial advisors. So like I said, it's after this evening, it's either through your banker. In the booklets that you've got, there's a little QR code. You can scan that. You can put in your details, and we'll get your financial advisor over the next little while to contact you and set up some time. And I think our financial advisors for Johannesburg are here as well. So they'll be outside afterwards if you want to chat to them. But in addition to that, through your app, through your online portal, you can also effectively invest. So many of our clients are quite comfortable. They know what they're saving for. They're saving for specific things, or they're looking to invest for retirement. And it's very quick and easy to do that also yourself if you want to online. I think Ferrell did ask Tabiso just around the work that we're doing to provide more content for you guys, more thoughts around what we're seeing, financial advice perspective or from an investment perspective. So we're looking to share more and more, over the next while, whether it's through our Investments 360 newsletter, or through those various other channels that you do engage with us. So please do look out for that. Again, thank you very much to my colleagues. I think hopefully the message this evening is that I think from an Investec perspective, I think there's two pieces of the puzzle that we hopefully provide for you. I think one, very, very sophisticated, level-headed investment professionals that are every single day thinking about how do we invest our clients' money, based on the trust that they've placed to us. And that's the most important thing. And then the second piece is that, to take effectively those professionals and what they offer and marry that to your specific needs. We've got our financial advisory team and a whole lot of other work that we will be sharing around guidance and education, etc. So when we bring those two pieces together, hopefully that does solve what Scott spoke about earlier, solve that need for yourselves. And I think the other thing just to flag is that our financial advisors are financial advisors in the sense that they can help across, all of your non-banking needs. So they can help with investments. They can also introduce the life insurance piece as well. And often it is very important to do those two things, those pieces together, because they do talk to each other throughout your wealth journey, whether you're, like you said, early on in your career, still growing your wealth to, whether you're later on and you've effectively, built up that nest egg and that wealth. So again, last one, thank you very much. Thank you, Ferriel. I think like Scott said, I think many of the people here actually came to see you, no disrespect again to our colleagues, and I don't think that they were disappointed. Thank you, everybody. Like I said, feedback afterwards, chat to our financial advisors, and thank you again for joining, and travel safe. Thank you.